Greetings, Professor McKee here with our next week's episode for Seminar Saturdays. This week's paper is about shopping for interest rates. The paper is called Search and Negotiation with Biased Beliefs in Consumer Credit Markets by Erik Berwart, Sean Higgins, Sheisha Kulkarni, and Santiago Truffa. My apologies if I mangled anyone's name there. This paper was presented at WFA back in the previous summer. And one of the reasons I wanted to look at this paper was because it's an actual randomized controlled experiment. Very difficult to do in finance, very rare to see. And it's always great when we can do it instead of having to rely on our econometric techniques, but in most settings it just won't work. And in this case, with consumer loans, they were actually able to do it. So when it comes to mortgages and also any sort of consumer loan product, shopping around is generally a good idea. It's highly recommended. If you talk to people in personal finance, you pretty consistently will get better deals if you shop around and do some price comparison. It's true for insurance, true for mortgages, lots of financial products work like this. But there's been previous research, according to the paper here, that is consistently finding people don't actually end up doing a lot of shopping. They end up paying quite a bit more, like hundreds or thousands of dollars more for these products. And so there is a natural question then, why does no one shop around, or why do they shop around less when there's a lot of money on the table? One proposed reason, which people have done research on in the past, is that, well, it takes effort. You have to actually go out and do these price comparisons. These are complicated products. These are difficult to compare. And so it might actually be rational to not shop because it's just too much work for the amount of financial gain. What this paper is going to focus on is a different reason, which is based on an incorrect belief about what the prevailing rates are in the market. So consumers might not understand the full benefit of doing more shopping because they have wrong beliefs about what the average interest rate would be and how much variation there is in the interest rate. And the reason both of those would affect your interest in shopping is like, well, you go out and you get a quote. If you have an incorrect belief about the average rate, you're going to interpret that quote based on what the average rate is. So if you think the average rate is higher than the actual market rate, and you get a quote and you're like, well, this looks like a really good quote compared to what I think the average rate will be, when in reality, it's actually not that great of a quote. If you have a wrong belief about the variation, the standard deviation of interest rates, again, you go out and get a single quote. If you think there's less standard deviation, less variation in how much the rates will move, you won't think there's as much potential for an improved rate when you do that. So depending on your beliefs, you theoretically might say, I'm not going to go shopping around because I don't think it's going to help me that much. So what is their experimental setting? They create a randomized trial where they record everyone's beliefs about the likely interest rate and then track the actual interest rate the participants received, and then record their beliefs about the likely interest rate after they received the loan. And they randomize what they show the participant at the beginning when they first contact them. So this is set in Chile, 2021 through 2023. They use Google Ads targeting people that are looking for consumer loans in order to recruit people. And they have a lot of participants. They have 112,000 participants that completed enough of the survey for us to see what they believed that the interest rate distribution was, what the average was, what the standard deviation variance was. And 46,000 completed enough of the survey that you could see types of price comparison tools that they say that they've been using. So they have a pretty large sample, given that they're doing basically kind of a randomized survey of people. They also get Chilean loan data from the government of Chile, so they can see what happened to these people after they complete the survey, if they actually went out and got a loan like they were looking at. So they had to have cooperation from the government here. This wouldn't have worked, wouldn't have been nearly as useful if they couldn't do that. Also, they also had a post-loan phone survey with the people that they had enough contact with. They got about 6,000 from that. They used WhatsApp as well on how much negotiation they did with their loans, another 2,000. So much smaller sizes there, but they were still able to get quite a few people. Okay, so with that survey data, they then compare it to the actual interest rate that the person received. So they in the survey they said how much they thought the interest rate was going to be, and then the author is able to look and see what was the actual interest rate that these people got when they went out and got the loan. And the people were generally wrong about what sort of interest rate the average rate was going to be. And it's also skewed. It's not an even distribution on either side of their estimate of what they thought the loan rate was supposed to going to be. If it was at zero, then they were exactly right. If they're way down here or way over here, then they were wrong. And they're mostly underestimating the actual rate. So there's a skew here, and there's also a pretty large spread. Like we're talking 20 basis points, 40 basis points. When we're working with mortgages, that can be a fairly large amount of money. So the fact that they are that far off is informative. If we think that there might be one of the reasons why people don't shop is because they're wrong about the average rate. Well, these people clearly are wrong. And in terms of their belief about the interest rate dispersion or variation, standard deviation, variance, they were also quite wrong, and they were also underestimating the variation. So again, there's a lot more people that were underestimating versus overestimating, but there's not many people who are right on the money either. Most people were very wrong. So there's underestimation for both average interest rate and variance, and then the authors work out sort of theoretically what that would result in terms of searching more or less. If you underestimate, that would encourage searching more because you think, oh, this rate looks too high. And you try again. You're like, well, this must be bad luck. The average rate really should be 7.2%, not 7.5%. I'm going to try again and maybe I get something closer to what I think the average is, even though the average is actually 7.5. If you underestimate variance, that would encourage searching less. Because then you don't think the rates will swing as much. You think there's less chances for you to get lucky and get a really low rate. And so you say, well, I'll just settle for what I have right now. So both underestimates are pushing against each other. One pushes towards more searching and one pushes towards less searching. They also do some tests in the appendix to try to understand why they're doing underestimation and rule out some robustness potential problems. For instance, one potential problem is that, well, I correctly estimated my interest rate back in January when I was first surveyed, but then I got the loan in April. And over 3 months, rates changed. So it looks like I underestimated because rates consistently changed in one direction, but actually I was accurate. It's just that because of the time delay, it looks like I was wrong. So they in that appendix, they limit the sample to only loans that originate the same month that you did the survey, so that would mostly remove any possible time trend. And they also look at things like what are the information sources for their interest rate estimate. So they ask them, what sources did you use to get your average and variance estimate? And the typical sources that they find people talking about are third-party comparison tools, basically bank ads from Google searches, looking at bank websites, talking to trusted people, family, and friends. And they are able to replicate what people would be seeing for the first three. So the third-party tools, the bank ads, the bank websites, so they can put in the information of what these people would actually have seen in those tools, not what they said they saw, but like what they actually would be shown with these three tools, because they have enough information both from the survey as well from the government data to know exactly what should be shown. And it doesn't, there's not a huge difference here between some of with some of these tools. So like if we're looking at Google searches and third-party comparison tools, the people who said they were using those, if you put in their actual information, those tools are both biased as an underestimate. They consistently underestimate a roughly 70% of the time, which is pretty consistent with what how wrong people were. The bank websites were actually unbiased. They weren't consistently 100% correct, of course, but they were very even split 50-50 of if it is it underestimate or overestimate. This was a pretty small sample size, much larger for Google searches and third-party tools. But if you are actually looking at the bank websites, which is who you're borrowing from, they don't seem to be lying to you directly on the website. But if you're doing other things, they seem to be incorrect and offering better prices than what you actually are likely to get. So the randomization here is that they show you different price comparison tools. So there's one group that are shown a actual price comparison tool. There's one group that's shown a much simpler tool with just an estimate of cost savings, and one group that's shown nothing, just a control video. Oops. And with the price comparison beliefs, do these beliefs change when you give them more information? Well, with the simple tool, there's not much of a difference. There's a little bit of action on what they think the lowest rate is going to be, which is how how you measure your dispersion, but otherwise nothing really changes. But if you show them the price comparison tool, the people that received the treatment of the price comparison tool, they increase their expected rate. They increase their estimation of the variance. Remember that most people were underestimating the expected rate and the variance, so this is probably moving in to be a more accurate measure of, more accurate estimate of what the people think the rate's going to be. And these are statistically quite strong. So 3 stars, they're at the 1% level basically. So it seems like showing that price comparison tool really improves your estimate of what the interest rates are going to be. And then, because they can see what actually happened, thanks to cooperation from the government, we can see what actually happened to the loans that the people who were shown the tool have versus people who didn't see the tool. And it does seem to have changed some of their behavior. So based on a mix of government data and some of their post-loan surveying data, if you were shown the tool, you seek out more loan offers. So you're shopping around more. You negotiate. You're more likely to negotiate on your loans. Your interest rate goes down, and you are weekly more likely to actually borrow. A different measure of the interest rate as well from the survey is also lower. And if you look at the administration data, at least the probability of taking the loan is higher, although there's no interest rate there as well. Some of these results are a little weak, but it definitely seems like they are reporting that they have more offers. They're also more likely to take on a loan. So there is some actual behavioral changes when we think that they have a better sense of what the average rate should be, what the variance should be. So it seems like the underestimate effect that results in more shopping around was beating out the underestimated effect that would result in less shopping around. And then they look at people who had an underestimate on the volatility, and not a lot changed. The only thing that is going on here is that they're more likely to negotiate. Now, negotiation is likely to be beneficial to them in terms of getting a better offer, but otherwise they're not shopping around more. They're not getting more offers and so on. And that is everything for the paper. And I skipped quite a few things from the appendix because those very focused on robustness test. But as I said at the beginning, this is a very rare. It's an actual randomized controlled experiment where whether you're shown that tool or not. And people are both they seem to be underestimating their average interest rate in the variance, and showing them that tool improves and corrects that bias. And it does seem to result in some real changes because we can actually see their real changes too, which is also a really great feature of this paper. Um, they seem to get better prices. They shop around more. Another thing that was kind of interesting that they found was that most of the sources, at least in Chile, I don't know if it's the same in the United States, a lot of these sources weren't very accurate, and they're biased. They're just outright biased, where they had pretty large gaps in their spreads, even if it's the bank website and it's 50-50 right around the actual interest rate. So these advertised rates, these tools don't seem to work that well, even if you seek them out. They seem to be kind of wrong about the actual market rates, which is not great. You would hope that they'd be better. I mean, ads are probably always going to be biased in favor of whoever is putting out the ad. But like the third party tools, we would hope would do a better job of giving you a more accurate picture. Although often there's additional information that the loan officer is going to see when you actually do the loan application versus the kind of more basic things you would put into a third party tool. So that concludes our paper for this week. Hope you enjoyed going over, once again, consumer loan products. If you did, please comment, like, and or subscribe so others can find this video too. And I will see you all next week with our next paper.